Here's what's coming up on today's show.
You want to have that healthy balance of liquid versus, semi-liquid versus, hey, if this takes 6, 9, 12 months, that's okay. So likewise, we encourage people to really have like a well-rounded portfolio.
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
On the program this week, we've got Craig Moser joining us, a financial advisor and certified financial planner, as always. And we have a special guest as well. We've got Nick Gonzalez joining us from Linville Team Partners. Nick is here to talk with us about some real estate different things. He's a CCIM. He's a partner, broker, and a great resource for you to tap into in the area when it comes to this topic. So looking forward to that conversation. Guys, welcome into the show this week. How are you doing, Craig? What's going on, buddy?
Just same thing, different day, just having a good time.
Well, that's good.
Let me talk a little bit about Nick, because you said a little bit. I want to say a lot.
There's
I've known
a lot,
this gentleman for at least 10 years. Right after he got out of kindergarten. And he's a little younger than I am. So anyway, he was born in Miami. He was educated in Barcelona, Spain, up to high school. He went to college here in Winston-Salem, NC School of the Arts. And he is the co-owner of Linville Team Partners here in Winston-Salem, which is a fantastic commercial real estate brokerage. Been a top-tier producer for over 4 consecutive years. So he's got a high-performance team. I'm excited to have him here to talk to us about all things real estate. So thank you for being here.
I'm very excited to be here, Craig, and thank you for the
looking forward to having
very
you here.
Flattering introduction.
Yeah, Winston-Salem under 40 as well. So board member from 2022 to
he's
the
a
present.
killer.
So he's getting it done. So let's educate some folks this week. Craig, what are we talking about?
Well, I just kind of want to look at the surrounding areas and see what his view of the real estate market is in general. Let me just start in. So, Nick, I'll put you on the spot here. What's the state of the real estate environment in the Triad area right now as far as what you see?
Yeah, so, general high-level overview, I would say cautiously optimistic. There's obviously some headwinds with cost of construction and interest rates, but as far as where we're located geographically, North Carolina is the place to be. Depending on what list you look at, North Carolina is either the 3rd, 4th, or 5th fastest growing state in the country. So that huge population influx has really driven a lot of the economic growth, small business growth, large employer growth. We're currently the 9th most populous state. We're on track to be the 5th by 2040. And even here, like in this region, you look at the announcements with Toyota, for example, which went from being a $5 billion plant to a $10 billion plant to I think it's 13 to 15 billion now.
Wow.
And those, those 5,000 jobs are going to lead to, so those are 5,000 Toyota-based jobs. That's going to lead to an extra 45,000 secondary jobs and population growth and, household needs and all this other stuff. So, the ripple effect is really, really, really tremendous. And that's money that's getting spent over the next 24 months, not over the next 5 years, 10 years, 15 years. So it's money that's going into the community right away. So, folks who are here have definitely felt the good and the bad of that. But generally speaking, I would say we're on a really, really positive uptick, and that applies to commercial real estate as well.
What do you see from all of the influx of people? Where are they coming from? Because you talk to them, I don't.
Yeah, so I read a study, and I don't want to quote, I don't have the exact numbers, but it was really funny because anecdotally, I think most people would tell you that they're seeing the majority of folks that are coming into this market, coming from the north, like New York and New Jersey. And
not the case?
Well, statistically, it's actually exactly the case because it was 30% New York, 25% New Jersey, and then the other 45% was literally everywhere else in the country. But it's funny because it's one of those rare times where, the stuff that people are seeing out on the street, they're like, oh, 3 people in my neighborhood just moved here from New York. Well, that's actually the trend. We are seeing a huge influx. New York lost 400,000 people last year, and so did California.
Wow.
And they're moving to, North Carolina, Florida, Texas, South Carolina. And their dollar goes, so much further here too. Both on the residential real estate side and on the commercial real estate side.
Yeah, my son Cameron just moved back from Utah, and he said substantially less here. But, we were at lunch the other day, and I was talking to someone, and they said Charlotte, not so much. It's pretty expensive there.
Charlotte, rents are out of control. There's nothing affordable. The residential house prices are through the roof. And even on the investment side, like you kind of have to be looking in the secondary markets like Mooresville, Gastonia, Concord, because in Charlotte you just have so much institutional money competing for investments that it's priced out a lot of the, a lot of local and like regional folks that are looking to put their dollars to work.
Wow. Well, since you said that, where are some opportunities in this area? If you were saying I'm going to invest in and you completed the sentence, maybe the better sentence would be I wouldn't invest in, but where do you see the opportunities right now?
So, that's definitely an interesting question to tackle because in terms of where we are in the market cycle, like there have always been really great opportunities in commercial real estate. There were lots of great opportunities when the market was, really bad. There's plenty of opportunities when the market is good, when rates are low, when rates are high. I would say right now where people are maybe missing opportunity is in existing buildings where your competition is new construction. So for example, we have very, very, very little industrial product in the Triad. And so you can purchase a 60s, 70s, 80s built warehouse or manufacturing facility for pennies on the dollar compared to what it would cost to build that new. So like, you might be able to buy something for, as an example, $50 to $5 a foot that would otherwise cost you $110, $150, and $120 a foot to build. And so if you're the owner of this kind of older vintage product, you can always compete on price. Whereas a lot of developers, what they're running into is they're building new, state-of-the-art, amazing facilities, but like they have to rent it for so much money. It's pricing out a lot of the people who would otherwise, be candidates for that. So I think when a lot of people think about commercial real estate, it's not always like necessarily the flashy thing that's going to make you the money or like the newer construction thing. It's just where can you stay competitive? And what we have is a lot of small business owners that need affordable space for their business. And that doesn't just apply to industrial. Like when you look at retail shopping centers, there's plenty of really great newer construction, class A top tier centers in the Triad, but that's not always going to make the best investment for someone local who's trying to get yield on their money. What's going to get them yield on their money is having like a, B plus type center where there's actually margin to be made between what they paid and what they're renting it out for. So I think that's where, the folks that are looking to purchase maybe their first, second, third commercial real estate asset, that's where they need to be looking is on some of these properties that maybe like need a little bit of love, but can be monetized, relatively easily because there's just a really big pool of tenants for more affordable space for, kind of like that small, like the local roofing company, the plumber, the hair salon that might have 2 locations, 3 locations. Those are the folks that you're going to make margin off of as tenants in your investment property.
So you work with real estate investors, all different attitudes and approaches and what have you. Where do you see the big colossal mistakes, the things that you look at and go, man, they're going to pay for that one?
Yeah, so there's really 2 answers there for sure. So I would say the number one mistake I see investors make is honestly just failing to take action, right? Like you don't want to make a bad investment, but so many folks will just sit on the sidelines for years without putting their dollars to work.
Well, like me. I think he's slapping me a little bit.
Well, there's definitely a difference between, being risk averse and not taking any risk at all. And so there's certainly something to be said for, being calculated in your approach and finding really the right fit. But I will say, like, there's folks that, I'll be talking to them for 2 years, 3 years, 4 years. When they finally pull the trigger on an investment property, they're so glad they did. But it's 2, 3, 4 years of a head start that like they didn't give themselves. And so it's not really like the mistake they're making. It's the chance, it's the risk that they're not taking by putting their dollars to work.
I'm the one that always chickened out when it was a big number. So if you're wondering, who chickened out on the deal, it was always me. But some of the things that Jennifer said that we should buy, had I bought those, I would be a much wealthier man today. I just was afraid. I was a little terrified. So you have to be measured in your approach. It's sort of like a well-rounded portfolio. When we look at an investment approach, it's not all just stocks and bonds for us. We like to see real estate in your portfolio because it just is a foundational element to allow you to be able to have a lot of appreciation, to allow you to have tax breaks, and also to be able to generate income, which is sort of the entire strategy behind any investment, is to be a foundational approach there. So as we're working with people, don't be afraid if you're mostly a real estate investor. We like that type of person, but we're also going to encourage you to have other investments outside of that, both for liquidity and other means of returning growth.
Yeah, and likewise, I tell my clients they definitely need to be well diversified, because you can't always turn around and sell a building in a day or two. You can't turn around and refinance a building in a day or two. So, you want to have that healthy balance of liquid versus, semi-liquid versus, hey, if this takes 6, 9, 12 months, that's okay. So yeah, likewise, we encourage people to really have like a well-rounded portfolio.
Let me just ask you a point blank question, Nick. What do you see for risk as an investor in real estate today? Where is the place where you could have a loss of income if you're not careful?
So in general, I think a lot of the big risks have passed to some degree. So a lot of folks are kind of calling the bottom as far as, the impact that all the interest rate hikes have had. A lot of folks are calling the bottom on the office market. Like, essentially, there's no consensus that it's going to get any worse than it is now. So that's good news, obviously. As far as risks go, like what we had seen in the past was folks really got used to having rates in this 3 and 4% range. And so when the Fed raised rates 11 times in a row, that caught a lot of people off guard. Fortunately, the valuations on properties have only continued to go up. And so a lot of those folks who found themselves, commercial loans, you have to refinance or renew your loan typically every 3 to 5 years. And so the folks that had these wonderful, 3.5% loans now found themselves having to refinance at 7.5%. Fortunately, a lot of the property values were there, so the refinance itself wasn't the issue, but their cash flow is greatly impacted by that. That's not really a risk when you're buying a property and going into it at a 7.5% rate like you are today. But I would say, yeah, like most of the investors I work with, the greatest risk they take on is just not budgeting enough for a possible vacancy or a possible large capital improvement. So, you always have to be ready to get that phone call that you never want to get, which is either the tenant telling you that they're going to move out, and now all of a sudden your cash flow is gone for the next 2 or 3 months until you fill the space back up, or getting the phone call and saying, hey, it's time to replace the roof. And by the way, that might be $20,000, $30,000, or $300,000. So I would say those are the primary risks, more so than like market conditions go, because generally speaking, I think everybody's very optimistic going into the end of this year and going into 2025.
Do you see the growth we have here nationwide? And if not, who's hurt, who's winning, who's losing?
Yeah, so I actually, I'm in a networking group with several brokers in different markets in the country, and every single one has a very different story to tell. The folks who are doing brokerage in Manhattan this is the worst they've ever seen it. It's worse than the great financial crisis. It's worse. They have never seen a worse commercial real estate market than the one we're in now. So it's really interesting to hear that perspective compared to, my perspective in North Carolina, where things are going great. And also, like another contrast I'll paint is, all we heard about for the last 3 years was Austin, Texas, Austin, Texas, Austin, Texas. And now we're kind of on the hangover of like that euphoria that was Austin, Texas, where all of a sudden activity's down 70%. All of a sudden, all these tech companies that sign these huge, office leases in Austin are now defaulting, or they're subleasing, or there's just so much vacancy. So I would say we're really, really fortunate here in the Southeast, and you don't see that in a lot of other places in the country. The other place you do see that, which is going to be maybe surprising to you, is like Columbus, Ohio. We spent some time up there looking at a couple of opportunities, and it reminded me a lot of kind of this market where you have a really steady stream of employers. Their big growth story. Ours is Toyota. Theirs is IBM. So IBM is building a 10 million square foot manufacturing facility there. So again, I think we're very lucky to be where we are because many other parts of the country are the complete opposite.
Let's talk a little bit about my favorite topic, taxes.
my favorite too.
Yeah. So as a real estate investor, I have seen some great mistakes where people would sell a piece of real estate not knowing that if they were going to buy another one, that they could actually do an exchange between property one and property two. Yes, the taxes still exist, but they're not required to pay them yet. That's either a 1031 exchange or a 1033 if for example, the state took your property to build a beltway. That type of exchange allows you to not pay the taxes right now. And we're seeing that more and more. These folks that are having their property bought, say, for example, for the beltway that's going in, then what happens is the state says we're going to buy your property for some sort of price, and now you have either a gain that you will pay them back for with taxes, or you need to exchange that at some point in time for another piece of property. Talk to us a little bit about how you guys work with folks with that, and also the benefits of exchanging that property.
Yeah. So, there's 4 things you can do, and it's really easy. 1, you can have a really, really great financial planner like Craig, for example.
Right.
2, you have a really, really great accountant who understands your overall financial picture really well and, analyzes it again every year over and over again and makes sure they're taking advantage of every loophole they can or every, opportunity, every single thing they can do. And then 3 and 4 have to do with, my world, have to do with commercial real estate. So the first one you mentioned, which is doing a 1031 exchange, you sell a property and you exchange into a similar property with complete deferment of your taxes. So rather than pay the tax bill, you get to take all your proceeds from the sale, defer all your taxes, and kind of grow that little, it's like a little snowball turning into an avalanche going down the mountain. You're not having to pay Uncle Sam every single time it goes to the next leg. So 1031 exchanges are and have been wildly popular amongst investors and high net worth taxpayers. And there's so many different strategies you can take with those. The most traditional is, you sell a piece of income producing commercial real estate or residential real estate, it doesn't matter, and you exchange into 1, 2, or 3 other properties. Sometimes you have what's called boot, you have leftover money. And there are kind of alternative strategies that you can take with that as well. So I know, Craig, you offer some products for people who find themselves in situations like that, where you can buy into, different fractional ownership of passive real estate investments that way. So the 4th strategy that I was mentioning, something called cost segregation studies. Those have become really, really popular recently because there's a bonus depreciation loophole that's actively closing. So we're 3 years away from them closing it. But basically what you can do is you purchase a piece of income producing real estate and you get almost like an appraisal on it. And you hand that appraisal over to your CPA and they can claim bonus depreciation based on those findings. So as a general rule of thumb, you might purchase $1 million property and instead of taking $29,000 or $30,000 a year in depreciation, you pay to get this study done, and they might find $200,000, $300,000 worth of bonus. So that $200,000, $300,000 flows through to your tax returns, and you realize an immediate tax savings on that. So when you pair both of those strategies together, doing a 1031 exchange, and on top of that, taking advantage of the bonus depreciation, commercial real estate in general, can be a really, really powerful tax savings vehicle.
So when you borrow money, most people say, okay, I'm going to go borrow money on my own personal home. I have so much in down payment and okay, I can go and get pre-approved for something and no problem. But when you're an investor, it's a different world, isn't it? How do you see accessing capital? How do you see how people can grow their own net worth with real estate, even if they're not a billionaire day one?
Yeah, so all the local lenders still want to do deals, right? So local lenders want to work with local investors to purchase local real estate. So there's always going to be funds available for these, smaller, medium-sized investment properties for the people that want to pursue those. As long as you have 25, 30, maybe 35% down, investment property is very accessible to you. The alternative you have is to partner up or, join forces with a group of investors, which will then allow you to possibly purchase like a more sophisticated asset or a larger property, which, a lot of my clients will find a really great deal and they might not be able to do it on their own, but I might have somebody else in my network who wants to come in on a deal with them, or, who might want to join forces because they bring one piece of the puzzle and someone else brings another piece of the puzzle. So there's no shortage of capital. Maybe what there's sometimes a shortage of is just the creativity aspect of it, where it's like, okay, it might not fit in the box exactly the way I thought it would, but with a little bit of creativity, you can pull it off.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax affiliated insurance agency.